CPI came in. Let's talk about it on Today in Mortgages. Hey, what's up, Dreammakers? Welcome back to the show. We're talking about what's real, what's hype, and we should actually be paying attention to out there in the world of mortgage and real estate news. It's Today in Mortgage. Rich, we had a big report come out. You had mentioned it on Tuesday. What do we get from our report yesterday?
Inflation continues to slow down. So that's good news.
That's good, Rich, but I wanted to bring it up today in the context of how the media writes about these things. We actually have two headlines we'll flash up on the screen. The first that I have here is from realtor.com via Yahoo. Inflation rises for the third straight month in troubling sign for mortgage rates. And then, Rich, I'm going to read you this second one, which might sound a little bit different. Mortgage rates head lower after CPI report. So, Rich, we say it heads lower. We say it's a troubling sign for mortgage rates. What's the real story here, and why are we getting different reads on this?
Well, it depends on the perspective that you're looking at this. The Fed has a mandate. The mandate is keep labor strong and keep the economy strong. That's it. And right now, labor is strong. You got a jobs report that was way more than expected last week. And the economy with this CPI report is just showing the economy is just humming. It's hot. And it might be slightly too hot. Like we have a mandate, or the feds have a mandate at 2% inflation. And now we're at 2.9%. So we're coming down, and there's going to be ebbs and flows, right? There's going to be some months, if you look at it on the micro, there'll be some months that are higher and some months that are lower. But overall, we're down from 2023. If you take the measurements in December of 2024, we're down. So that's good news. The problem is everybody wants the Fed fund rate lower because businesses, our economy, it's more expensive to do business when the Fed fund rate is as high as it's at now, because that's borrowing costs. Every business needs to borrow for this and that. Small businesses, big businesses, every mortgage rates are high because of the Fed funds rate. So we all want a strong economy and we all want great labor, but we also want cheap money. So it's just a catch-22. They have to keep the cost of funds higher to control inflation. So it really just depends on who you're talking to. If you're talking to someone trading bonds, yeah, they want yields high. They want to see a bigger return on their investment in bonds. If you're talking to somebody that's selling mortgages, we want it low. So it is what it is.
So, Rich, one of the things you said there is it depends on the perspective. And what we saw in the numbers is that inflation actually was up slightly from last month, but lower than what people thought that it was going to come into this month. And so even though it had ticked up barely a little bit, it actually was lower than what the analysts were forecasting. And so that fact that it was lower kind of set the markets into the direction they went yesterday. Rich, tell us what happened yesterday and where we're at today on the street rate for mortgages.
Yeah, the 10-year yield came down yesterday, maybe, I don't know what it ended up at the end of the day, but let's say it's like 10 ticks lower. So it got a little bit better, which we saw some slight improvements in the streets for rates. When I say slight, I mean, I'm talking about tiny. We're just talking about little baby steps. So, but, today we're starting to see some of it giving back, and then we're improving just a little bit. But it's ebbs and flows. We can't really focus on the day. It has to be over a term. If we get lucky, like we are at Network Funding, we're looking at this every day. Like some days might be a day lock. Take advantage of the small improvements that we receive that day. We're locking as many of our clients as possible. But then there's days where, it just doesn't look good. We get numbers that weren't expected, and the market goes a little bit sideways, and we lose everything we gain. It just comes and goes so fast, but we just can't get bogged down into the day-to-day. That's what we're talking to our borrowers about, and they're concerned. When do I lock? Our advice is, if it fits, if you qualify and the payment is reasonable to you, lock, forget about it. Nobody needs the stress of managing interest rates on a daily basis. They are what they are. If you qualify, lock it. Again, this is a temporary thing. The only permanent thing about a home purchase is the purchase price. The rate is temporary. As rates come down the road, you're going to refinance. And our pros are going to be looking after your mortgage all the time for a refinance opportunity to save you money. So just lock in your purchase price today before home and prices continue to increase, and just let us manage your refinance for you later.
That's right, Rich. And now's a good time to remind everyone out there that we are part of the best network in mortgage. And we are data driven here, but we're also relationally driven. And so if you're looking to make a fresh start in 2025, reach out, click the grow link below. We'll get you all the information you need to know about network funding. Hey, Rich, so you mentioned a lot of different things here. The CPI report came out. We had the jobs report last week. We had the PPI early this week. Generally, overall, things kind of going a bunch of different directions. But after that report, how are you feeling about our chances for at least a rate pause as opposed to a hike or a decrease in the next month?
Well, we're going to pause. We're going to see a pause. The one thing that these reports have done is basically taken a Fed fund rate hike out of play. So it's pretty much out of play. So now we're just looking at cuts, but there will be a pause. In fact, depends on what you read and who you listen to. First, just 2 weeks ago, they were saying we're going to see 2 Fed rate cuts this year, likely towards the end of the year. Well, now they're saying maybe we see 1. But listen, who cares? Next month, they might be saying we're going to see 3. It just depends on the data, because it's all data driven, and it's backward looking data, right? We're reacting to something that already happened. Everybody understands rates are where they are. We're gradually going to come down over time. We're just seeing inflation slowly reducing to what the Fed's target rate is 2%. So we're lower than we were before. We're lower than we were in 2023. So those are all good signs.
Thanks so much, Rich, for your insights here. Thanks to everyone out there for watching and listening wherever you are. We appreciate you. We'll see you next time on Today in Mortgages. Today in Mortgages is produced by Network Funding LP, which is an equal housing lender, NMLS 2297. The content of this program is meant to be a commentary on mortgage and real estate news, and any discussion of rates and or products should not be taken as an individual mortgage or home buying advice or pricing estimates. And any commentary on this show should not be considered a promise to make a loan. All applicants for a loan must qualify, and you should consult a professional regarding your individual loan scenarios for your financial situation. Visit our website at nflp.com/licenses for all state licensing and other legal information.